Welcome back to Singapore Tonight. Once touted as a stable, long-term play for investors, real estate investment trusts, or REITs, are losing their shine due to COVID-19. Particularly affected are trusts in the hospitality and retail sectors. But analysts say there's an upside for some segments, including industrial and commercial REITs. Michelle Teo reports.
Travel bans have affected the profitability of the hospitality sector, while declines in mall traffic have impacted the outlook for some REITs in the retail sector. Some analysts note that these changes have dulled the attractiveness of REITs as an investment product.
Traditionally, investors would look at REITs as low volatility and high yield type of investments, but the around 40% annualised volatility that we've seen in the REIT market has seen investors come in and move into the market as and possibly take short-term trading positions.
In addition, the uncertainty of REIT managers in managing income levels have seen distributions being cut. SPH REIT, for instance, which manages malls like Paragon, slashed its distribution per unit by 79% in its second quarter review, with the retained income used to offset tenant rentals. Looking ahead, unlike major consolidations among REIT players seen in 2019, analysts believe REITs will operate in survival mode.
At this time, rather than chasing growth, they will be thinking more in terms of how they make sure that they are sustainable, whether their tenants are being taken care of appropriately during this time so that the longevity of the income is there. But that being said, unless we see distressed assets in the market or distressed REITs, which actually did happen during the past financial crisis, then yes, some of this consolidation may happen. But in terms of one big REIT buying another REIT, we don't think so.
Come 22nd June, about 12% of the listed companies on the benchmark Straits Times Index will be REITs. Analysts say this marks a more resilient performance for some REITs compared to other products in a global recession.
We think the industrial REITs, particularly logistics, would do well, but they need to think more in terms of how do they go up in terms of specifications. So maybe more capital expenditure to try and make the properties more catered for the e-commerce space. The other sector which we think will hold up is office, at least in the next 1 to 2 years when the leases are still there until further structural changes come in.
For now, one analyst still thinks the valuation of some REITs in the current market is fair.
Industrial logistic REITs, you can see in terms of their valuations to where they have been in the last 5 years, they're generally pretty close to where they were. But then you are seeing those REITs that were more affected by the volatility in the first part of the year, such as the hospitality REITs and the retail REITs, still trading at discounts to their 5-year, 10-year averages.